For 80 years, U.S. Treasury bonds were the single largest reserve asset held by central banks around the world. They were considered the safest, most liquid financial instrument in existence. According to data published this month, gold has now overtaken U.S. Treasuries as the largest reserve asset on the planet. Gold accounts for 24% of global central bank reserves, while Treasuries have fallen to 21%. A decade ago, that ratio was 9% gold versus 33% Treasuries. In this video, we'll explain how this historic crossover happened, what central bankers are actually signaling about the dollar, and what it means for the rest of us. To understand why this matters, we have to go back to 1944. At the Bretton Woods Conference, 44 allied nations agreed to a new monetary order. The US dollar would be pegged to gold at $35 per ounce, and every other currency would be pegged to the dollar. At the time, the United States held roughly two-thirds of the world's monetary gold. In 1971, President Nixon ended dollar convertibility into gold. From that point on, U.S. Treasury bonds effectively became the new gold. They were the global risk-free asset, backed by U.S. fiscal credibility rather than metal. The petrodollar system reinforced this. Oil was priced in dollars. OPEC nations recycled their dollar surpluses into treasuries, and every barrel sold anywhere in the world created permanent demand for U.S. debt. This arrangement worked for roughly 50 years. The dollar's share of global reserves peaked at around 71% in 1999. So why is it breaking down now? The most important turning point was February 2022. Following Russia's invasion of Ukraine, the United States and its allies froze approximately $335 billion of Russian central bank reserves. This was the largest financial seizure in modern history. To be clear, central bankers had always understood that dollar reserves came with political conditions. But the scale of the freeze made something undeniable. Dollar reserves are not neutral assets. They are conditional on political alignment with Washington. A May 2025 survey of 84 central bank reserve managers found that 85% believe the weaponization of reserves will have significant consequences for how they allocate assets going forward. The percentage who classify U.S. sanctions as a significant allocation risk jumped from 30% before 2022 to 76% afterward. Then there is the fiscal picture. The U.S. federal deficit ran at 5.9% of GDP in 2025. The IMF now projects deficits in the 7 to 7.5% range for years to come. U.S. general government debt is 124% of GDP and is projected to exceed 140% by 2031. The IMF's own director recently said the U.S. needs to reduce its deficit by 4 percentage points of GDP. There is no plausible political pathway to do that. CBO projections show that net interest payments alone will reach $2.14 trillion per year by 2036. By 2029, interest becomes the second largest line item in the federal budget. By 2047, it becomes the largest, surpassing Social Security. This brings us to what reserve managers are actually looking at. Roughly $9.7 trillion of U.S. debt rolls over in fiscal year 2026 alone. That's about one-third of all marketable Treasury debt being refinanced in a single 12-month window. The 30-year Treasury is currently yielding around 4.91%. Every additional 100 basis points on Treasury yields adds roughly $300 billion to annual U.S. interest costs. This creates what economists call a sovereign rollover trap. When central bank reserve managers diversify away from treasuries, the marginal buyer disappears. Yields rise. The Treasury has to issue more debt just to service the existing debt. Deficits widen, more buyers step away, and the cycle compounds. This is the doom loop that gold buyers are quietly pricing in. So why gold specifically and not something else? The euro has fragmented sovereignty. The Chinese yuan has capital controls and an opaque financial system. Bitcoin is too volatile and too small. Gold is the only major reserve asset that is no one's liability. It cannot be frozen, sanctioned, defaulted on, or printed. In 2025, the Banque de France moved 129 tons of gold from the New York Fed back to Paris, generating a 12.8 billion euro capital gain. Brazil sold $61 billion of U.S. Treasuries in 2025 and simultaneously doubled its gold reserves. China has now bought gold for 16 consecutive months and holds roughly 2,309 tons. To be clear, this is not a precious metals trade. This is institutional behavior. None of this means the dollar is collapsing tomorrow. The dollar is still involved in 89% of global foreign exchange transactions and still accounts for roughly 57% of allocated reserves. But foreign-held treasuries at the New York Fed recently fell to a 16-year low below $3 trillion. The institutional money is visibly moving. If reserve diversification continues, U.S. borrowing costs rise structurally. That means higher mortgage rates, higher car loan rates, and mark-to-market losses on the treasuries sitting in pension funds and ordinary 401(k)s. The warning signs were institutional before they became personal. They always are. For 80 years, the implicit deal was that the United States would provide a stable, neutral reserve asset, and in exchange, the world would permanently hold its debt. The institutions whose job it is to make that deal work have quietly started building a Plan B, 1 ounce at a time. What do you think about gold overtaking U.S. Treasuries as the world's largest reserve asset? Let us know in the comments section below. And as always, thank you for watching.